As Tesla continuously dominates the advanced innovation of the EV industry, the company is also a trendsetter when it comes to the manufacturing process. But 2020 has proven to become a very challenging year for Tesla. Just like what CEO Elon Musk described, Q2 is a tougher quarter for the company, as it experienced several drawbacks during that period. Amidst Tesla's performance of the recent quarter, analysts consistently remain optimistic with their views towards leading EV automaker Tesla. Deutsche Bank is also looking forward to Tesla recovering in the second half of the year. Will Tesla stock bounce back? There's something interesting that you might not have considered. Stay tuned to find out what it is. Before we start, if you like this type of content, hit the like button, subscribe, and turn on notifications to keep up to date on everything going on with Tesla. For the past few months, we have seen a downward trend in Tesla's stock from April 2022. Now, the stock of the leading EV manufacturer is less than $700 and is on an upside-down move. If we're going to take a focus, then the current level of the company's stock is at around 35% down from last year and around 50% below its all-time high. I'm pretty sure that many people, especially Tesla fans, are trying desperately to see what will happen to the company's stock. But before we get into our deep discussion about this, let's first have a short review of the recent happenings on Tesla. Right after the company released its production figures for the second quarter of the year, it presented the highest sequential drop from the last 2 years. Based on Tesla's investor relations page, the EV maker company produced 258,580 vehicles and delivered 254,695 for the second quarter of the year. If we then take a look at Tesla's delivery from the first quarter, a huge gap is visible. The recent delivery figures presented an 18% drop from the first 3 months of the year and the last year's final quarter. The COVID-19 restrictions, supply chain problems, and semiconductor chip shortage, and other part shortages have had an impact all on this. If we're going to make a comparison from the same quarter last year, the delivery numbers show sales growths of around 26.5% year over year. However, the recent figures for deliveries did not meet the expectations of various analysts. Despite what happened, many analysts and Tesla bulls remained confident about their positive take on Tesla. According to one of the biggest in the world, Deutsche Bank, a German multinational investment bank and financial services company, Tesla's stock was pretty attractive and would have had a sharp recovery after the second half of 2022. With this, the firm shared its price target at $1,125, about more than 65% where it closed last Friday, as they restored their buying rating for the company's stock. In addition, the firm also said that Tesla is also on its way to supply around 1.4 million vehicles this year. This is insanely 50% of last year's total units. The firm believes that the new factories in Berlin and Texas, as well as the reduction of COVID-19 related lockdowns in China, are going to play a huge role in this. The firm also called Tesla's second quarter production and delivery honorable, despite headwinds that the EV manufacturer experienced. Moreover, Deutsche Bank also highlighted Tesla's strong pricing capabilities. According to the firm, Tesla's pricing power can do more than offset inflation, helping the company to maintain higher margin profits. When a company has the ability to price, it primarily shows the effects that the change in the price of a product has on the demand for itself, and it exceeds stock with strong pricing ability during and after high inflation. In 2021 alone, Tesla increased by 10%. Then, significantly more in March, and again in June, we saw the prices go up again. But the price and the waiting time for the car are getting longer, and not less, which reflects Tesla's superior brand and product positioning, analyst Emmanuel Rosner said. All in all, our vision is that Tesla remains an EV maker with a higher margin profile through both price capability and operational leverage, the analysis added. In the same line with Deutsche Bank's perspective on Tesla, CFRA VP and equity analyst Garrett Nelson remained on his bullish stance towards the company. With an almost 30% decrease in Tesla stock in the past 6 months alone, Garrett said that now is the time to invest in the company's stock. As he quoted, "It is a generational investment opportunity." The analyst and his firm foresee the setup of the leading EV manufacturer, similar to the world's largest companies like Apple and Amazon 10 to 12 years ago. With the current phase of Tesla, what they're doing in the industry is to act as disruptors as they continuously take a huge amount of market share. This is exactly what Apple and Amazon did during their time. Furthermore, Garrett and his firm think that Tesla's stock has been unfairly punished. With the 30% down, the company remains the best performing auto manufacturer that they cover with a wide margin. He also pointed out that Tesla has been hit extremely hard in the past few months, as the company beat 10 of the last 11 quarters. Tesla did not receive any credit for the positives that they did. Although Garrett reduced his 12-month price target for the stock of Tesla to $1,100, down from $1,200, the analysis still maintained his strong buy rating for the company's stock. Correspondingly, RBC Capital's Joseph Spack upgraded Tesla's stock, citing that the company has favorable positioning, despite uncertain circumstances during the recent quarter. Spack also noted that Tesla is in a great setup for both short-term and long-term markets by having a competitive advantage because of the company's vertical integration model. According to Spack, Tesla could expect an upside margin for this year's second quarter and the back half, despite downs in delivery figures from the first quarter to the second quarter. Just like what Deutsche Bank pointed out, Spack also mentioned that Tesla could see up to 3% in a boost in average selling prices. Given the pricing actions Tesla has taken a while back, but not being able to realize as they have been working through their backlog, he said. In connection with this, Oppenheimer & Co. Incorporated also stayed bullish on Tesla, based on its factors in earning leverage, Tesla's leadership position, and the latest share price slide. The firm thinks that the current problems of the company will be fixed accordingly by Q4, but they also expect some pressure on margins soon. Also, they're looking forward to Tesla releasing new sets of features as they believe that the autonomy competition is building up. Oppenheimer analyst Colin Rush, who has a 71% success rate in predicting Tesla's price movements, recommends that investors should buy the company's stock. Meanwhile, not all analysis and financial firms view Tesla stock all the same way. In a recent note, JP Morgan Chase & Co., a financial company, trimmed its price target for Tesla stock to $385 from $395. This represents a potential decrease of around 41% from current levels. The company believes that there's a possibility that Tesla could fall a lot with the continuous problems at the company, and also the production slowdowns of its factories. The recent call of JP Morgan came after Tesla released weaker than expected vehicle deliveries for the second quarter of the year. As the company experienced supply chain issues, battery metal inflation, and higher costs for other commodities, JP Morgan said that the interplay of price and cost can be a huge toll on the company's earnings this year. According to the JP Morgan analysis, Tesla's valuation appears to be pricing in upside related to expansion into mass market segments well beyond our volume forecast for the Model 3 and Model Y. This primarily explains the underweight rating within the company's stock, which means that Tesla's investor must cut their respective stake under the weighting assigned to the automaker company in several indexes. Why don't we take a pause with firms and analysis expectations for Tesla stock and move on to what the company plans for its stock. Back in March 2022, Tesla announced that the company intends to do another stock split, but didn't reveal the details. Last month, they announced that there will be a shareholder vote at the upcoming annual meeting about the 3-for-1 stock split. This primarily means that if you have one Tesla share, then you're going to get 2 more. Well, stock splits do not have a direct impact on the company's performance. They do primarily reduce the price per share, making it more accessible. But the big question is, will Tesla's stock rise after the stock split? If we're going to look at historical figures, stock split is effective as it has been well received by shareholders. We've also seen that Tesla did a 4-for-1 stock split in 2020. During that time, Tesla was trading at around $1,300 per share, and the stock split made the price go to $2,000 per share, making it a company's record high. With the current phase of Tesla, a rebound after the split will probably be a great result for shareholders. As Wedbush analyst Daniel Ives said, Tesla's plan to have a stock split this year will have a massive catalyst for the company's stock price in the coming days. So, on what side are you on when it comes to Tesla's stock price within the next few days? On the bullish one or not? Let us know down below, and while you're still here, go ahead and click on one of these 2 videos on your screen. See you there!